Welcome to the deep dive. Today, we're diving into something I bet many of you are thinking about, especially if you've seen those, amazing Barndominium pictures online.
Or maybe even sketched out some plans yourself.
Exactly. The big question is, how do you actually finance building a new home, maybe a cool Barndo, without getting totally bogged down in paperwork?
Right. Because the traditional way, it's often, well, complicated. You get a construction loan first, build the house.
And then you have to get another loan, the final mortgage, right?
Precisely. So that means 2 applications, 2 closings, often more stress, more costs. It's a lot.
It sounds exhausting, frankly, like running 2 races back to back. So today we're looking at something much simpler. We found a great article about financing Barndos, and we also had a listener ask how to contact a lender about this very thing.
Yeah. So we're focusing on the one-time close construction loan, sometimes called a single close or just OTC.
One-time close. Okay.
The name kind of gives it away. It's all about efficiency. Basically, one application, one closing. And that covers both the building phase and the permanent mortgage.
Okay, so our mission today is to really unpack how these OTC loans work, look at the different types like FHA, VA, conventional, and how they apply to building, well, any home really, but including those barndominiums everyone's talking about.
And just a heads up, all the info we're sharing is current as of today, Tuesday, April 22nd, 2025.
Great. So let's dig in. This one and done idea. What exactly is a one-time close construction loan in practical terms?
Okay, think of it like this. Instead of that whole double process, applying, closing, building, then applying and closing again.
Yeah, the exhausting part.
Exactly. You do the application and the closing just once, right at the very beginning, before a single nail is hammered.
Okay, so everything's locked in up front.
Pretty much. That one loan covers the construction costs, usually paid out in stages to the builder.
We'll get to that, I assume.
Yep. And then once the house is built and signed off on, that same loan just flips. It automatically converts into your permanent mortgage.
Wow. So no second round of loan applications, documents, credit checks?
Nope. None of that. That's the beauty of it. You reduce the paperwork massively. And a big one, you only pay one set of closing costs.
That could be a significant saving right there.
It definitely can be. Plus, that transition from building to owning is just seamless. No stress about requalifying or rates changing dramatically right at the end.
That seamless part, that sounds like a real game changer. So, okay, if someone's looking at building, why specifically choose OTC over the old 2-loan way? What are the main selling points?
Well, it really boils down to, I'd say, 3 main things: simplicity, cost, and that smooth transition.
Okay, simplicity first.
Just one application form, one approval process, one pile of documents instead of 2. It just cuts down the complexity, takes some of the overwhelm out of it.
Less paperwork is always good news. Always.
Totally.
Then, the cost savings we mentioned. Paying those closing costs, title fees, appraisals, recording fees, all that stuff, only once instead of twice. That can add up to thousands.
Right. And the third thing, the transition.
Yeah, that smooth move. Imagine finishing your build and just starting your regular mortgage payments. No frantic last-minute scramble to get a permanent mortgage approved. It removes a huge potential stress point right when you just want to move in.
Okay, that sounds incredibly appealing. Now, are there any catches? Or maybe things you really need to have sorted out early on if you go this route?
Good question. Yes, preparation is even more critical with an OTC loan because you're locking everything in before construction.
Right, the lender needs certainty.
Exactly. So you'll need really solid plans, detailed architectural plans, a comprehensive budget breakdown for the entire project, and crucially, your builder needs to be chosen and approved by the lender before you close on the loan.
Okay, so builder approval happens before the loan closes.
Yeah.
That's important. Very important. The lender needs to know the builder is qualified, insured, and financially stable. So, yeah, more homework up front.
But it sounds like that upfront work pays off later by making the rest smoother.
That's generally the idea, yes.
Okay, let's dive into the specific loan types. The article mentioned FHA one-time closed loans, particularly for Barndos. What are the advantages there?
Right, FHA loans. They're backed by the government, the Federal Housing Administration. The big draw for many people is the lower down payment requirement.
How low are we talking?
It can be as low as 3.5%, depending on your situation, like your credit, and if you already own the land. That makes building accessible for folks who might not have a huge chunk of cash saved up.
3.5%, wow. That's a big difference compared to traditional mortgages sometimes.
What about credit scores for FHA? Are they a bit more flexible?
Generally, yes. FHA guidelines tend to be a bit more forgiving. The article we saw suggested a score around 620 might be enough to qualify with some lenders, though it always varies. Okay, 620. That can help people who maybe aren't quite perfect on the credit front. Are there any specific rules or maybe downsides with FHA OTC?
Well, the main thing with FHA loans is mortgage insurance premium, or MIP. You usually pay a portion upfront at closing, and then an annual premium that's rolled into your monthly payments.
Mortgage insurance.
Yeah, it protects the lender because it's a lower down payment loan.
Yeah.
Also, a really key requirement. The home built with an FHA loan must be your primary residence, your main home. No investment properties or vacation homes.
Got it. Primary residence only. Okay. Now, what about VA one-time close loans? The article mentioned those too. What's special there for veterans?
Oh, VA loans are fantastic for eligible veterans and active duty members. The biggest benefit often is the potential for zero down payment.
Zero down? Really?
Yep. 0% down. It's a huge advantage, obviously.
Wow.
Makes building a home much more attainable for many who've served.
That's incredible. Any other perks?
Similar to FHA, they can have slightly more flexible credit requirements again, maybe around that 620 mark or higher, and another massive plus. Typically, there's no ongoing mortgage insurance required with VA loans.
No mortgage insurance and zero down. That's huge savings.
It really is. Same rule applies, though it has to be for the veteran's primary residence.
Makes sense. Those are amazing benefits. Okay, let's switch to the non-government options. Standard or conventional one-time close loans. How do they differ?
So conventional loans aren't backed by the government like FHA or VA. That means the requirements are often set by the lenders themselves or sometimes by entities like Fannie Mae or Freddie Mac. Generally, you'll need a larger down payment.
How much larger, typically?
The source mentioned around 5% as a possible minimum for some conventional OTC programs, but it could be more, depending on the lender and your profile. Definitely more than FHA's 3.5% or VA's 0.
Okay, and credit scores. I'm guessing they need to be higher, too.
Usually, yes. Conventional loans often demand stronger credit. The article pointed towards a minimum score of maybe 700 for some of these programs.
Right, so a higher bar for down payment and credit. What about mortgage insurance with conventional?
Good question. If you put down less than 20% on a conventional loan, you'll almost certainly have to pay private mortgage insurance, or PMI.
PMI, right. Similar to FHA's MIP, but for conventional.
Exactly. It protects the lender. The PMI usually starts once the loan converts to the permanent mortgage after construction is done. But the upside with PMI
is that you can get rid of it eventually.
Yes. Once your loan balance drops below 80% of the home's value, meaning you have at least 20% equity, you can typically request to have the PMI removed. Unlike FHA MIP, which can sometimes last for the life of the loan.
That's a key difference. Being able to ditch PMI is a big long-term saving. Any other advantages to conventional OTC loans?
Sometimes they offer a bit more flexibility. For instance, while FHA and VA are strictly for primary homes, some conventional OTC programs might allow you to finance the construction of a second home or a vacation home.
Ah, okay. Good to know if it's not your main house. Now, let's zoom in on the Barndominium angle again. Lots of buzz around those. Using an OTC loan for a Barndo, any special considerations?
Yeah, it's great that these loans can be used for Barndos. Our source even mentioned lenders specializing in them, which is helpful. The main thing that can sometimes be a bit trickier is the appraisal.
Why is that? Because they're less common?
Sort of, because Barndos can be unique in design and structure, and there might not be many similar properties nearby that have recently sold what appraisers call comparables or comps. Finding good comps can be challenging.
Right. Hard to value something if there's nothing quite like it around.
Exactly. But experienced appraisers, especially those familiar with construction and unique properties, know how to handle this. If the Barndo has, similar living space, bedrooms, baths to a conventional home, the structure type, like the metal shell, isn't always the biggest factor.
Okay, so it's manageable, just needs the right appraiser.
Pretty much. And just to reiterate, the builder factor is still key. Your Barndo builder needs lender approval just like any custom home builder. Their experience and financials will be checked out.
Got it. Same process, unique house. Now, if someone's listening and thinking, okay, this OTC thing sounds good, what are the actual steps? Walk us through the typical process.
Sure. It usually kicks off with pre-qualification. That's the initial chat with the lender, giving them your basic financial picture, income, debts, assets. They give you a ballpark figure of what you might be able to borrow.
Step 1, get the ballpark, check. Then what?
Then comes the more detailed review. You submit a full application, pay stubs, bank statements, tax returns, all that stuff. The lender digs into your credit report, your finances.
A deep dive, basically.
Yes. They'll also look at your preliminary plans and your chosen builder at this stage. Our source noted this review part can take a bit of time while they do their homework.
Patience is needed, okay, after the review.
Next is the formal builder approval. This is where you submit the builder's info license, insurance, references, financials, along with your signed construction contract. The lender then works directly with the builder to get the detailed plans, the specs, the cost breakdowns, and that all-important draw schedule.
The draw schedule, that's the payment plan for the builder.
Exactly. It outlines when the builder gets paid as they hit certain construction milestones. So once the lender approves you, the project, and the builder.
Then you get the green light.
Then you get the green light for closing. You go to the title company or attorney's office, sign all the final loan documents. Funds are then officially set aside, usually in an escrow account, ready for construction.
Okay, closed. Funds are ready. How does the money actually flow to the builder during construction?
Through those construction draws we mentioned. Based on the agreed schedule, after the builder completes a specific phase of work, say, pouring the foundation or framing the house, they request a draw.
And the lender just hands over the cash?
Not quite. Before releasing the funds for each draw, the lender sends out an independent inspector. They visit the site, check the work completed matches the plans and the draw request. If everything lines up,
then the builder gets paid for that stage.
Correct. It's a system of checks and balances to make sure the work is actually getting done properly before the next chunk of money is released. Protects everyone involved.
Smart. Okay, so draws happen throughout the build. What's the very last step?
Finalization. Construction is finished. You do a final walkthrough. The final inspections are completed, like getting the certificate of occupancy. Once everything's signed off,
The magic happens.
the magic happens. That initial construction loan automatically converts into your permanent mortgage. No more paperwork, no second closing. You just start making your regular principal and interest payments, like any standard mortgage.
That really does sound so much simpler than the old way. So just to wrap our heads around it, who is this OTC loan really best for?
Well, honestly, anyone building a home who values simplicity and predictability in the financing process, if you want to avoid the stress and potential cost of two separate loan closings, it's definitely worth looking into.
And it works for different financial situations, right? With the FHA, VA, conventional options.
Exactly. Whether you need the low down payment of an FHA, qualify for the amazing benefits of a VA loan, or fit the profile for a conventional loan, there's likely an OTC option. And it applies whether you're building a traditional stick-built house or, yes, that dream Barndominium.
The whole point is streamlining that journey from dirt lot to front door.
Precisely. Making it as seamless as possible.
And for listeners who are thinking, yes, this sounds like me, especially the Barndo builders, we should mention that contact number again. The source provided, 888-857-8041.
Yeah, that sounds like a direct line to folks who specialize in these, which could be really helpful for getting personalized answers.
Definitely worth the call, if you're serious. Okay, so the big takeaway here. One-time closed loans really can smooth out the financing bumps when you're building new. Traditional house or Barndo, doesn't matter.
Absolutely. Consolidating everything into one loan, one closing. It saves time, potentially money on closing costs, and definitely cuts down on the stress factor compared to juggling two loans.
It makes you think, doesn't it?
Mm.
If you're planning a build, what could you do with the time, energy, and maybe even money you'd save by going the one-time close route?
Yeah, maybe put it towards that nicer countertop you wanted, or just enjoy the building process a bit more without the financing headache looming. It's a powerful option.
A great tool for the home building toolkit, for sure. And checking out that number seems like a solid next step for anyone interested.
Couldn't agree more. Getting the right info for your specific situation is key.
Well, here's hoping this makes the journey to building that dream home a little bit easier for some folks out there. Thanks for taking this deep dive with us.